When borders follow the money, it began without armies or declarations. A line moved on a map because money moved first. What looked like diplomacy was actually accounting. And by the time leaders noticed, borders were already changing. To understand why territory followed currency, we must return to a Europe stitched together by fragile agreements. Kingdoms rose and fell, but trade endured. Merchants crossed borders more often than soldiers, and their routes quietly defined which regions prospered and which withered. Long before modern states hardened their edges, money flowed freely, obeying logic rather than flags. And where money settled, power followed. The first reveal appears in the ledgers of regional banks operating along contested frontiers. These institutions did not care who ruled a town. They cared who paid debts reliably, enforced contracts consistently, and protected trade corridors. When one authority weakened, capital drifted toward the next strongest guarantor. Loans were refinanced across borders. Tax revenues were redirected through intermediaries. What looked like commerce was actually allegiance shifting in slow motion. The second beat came when local elites noticed a change. Landowners began holding assets in foreign currencies. Guilds registered contracts under neighboring jurisdictions. Even courts started referencing external financial codes when settling disputes. Official borders remained the same, but functional control had already slipped. Authority followed whoever controlled credit, not whoever flew a banner. At first, rulers dismissed these shifts as temporary. Coins always travel, they said. Markets fluctuate. But beneath the surface, something irreversible was forming. Once debts, wages, and savings aligned with an external system, loyalty became transactional. Protection was no longer expected from a crown, but from the balance sheets that sustained daily life. And quietly, without conquest or rebellion, the map of Europe began to redraw itself, one payment at a time. The shift accelerated as uncertainty deepened along the frontier regions. Once capital began flowing outward, it created a gravity that pulled more value with it. Merchants preferred stable currencies over patriotic ones. Workers demanded wages and coin they could trust. Savings migrated quietly across borders through banks that promised consistency rather than loyalty. What had started as a precaution became a pattern. As the reveal deepened, administrators found themselves powerless to stop the movement. Attempts to restrict foreign currency only confirmed its desirability. Controls tightened but enforcement lagged. Smuggling increased. Barter networks formed to bypass official channels. Each intervention pushed more economic life into the shadows, where allegiance followed efficiency, not law. The conflict took shape when regional governments tried to reclaim authority through taxation. They raised levies, demanded payments in state-issued money, and threatened penalties for non-compliance. But these measures backfired. Traders simply rerouted business. Landowners transferred holdings to relatives across the border. Even tax collectors began accepting alternate currency in practice, if not in policy. The state still claimed the territory, but it no longer governed its economy. Neighboring powers noticed the drift. Banks across the border expanded branch networks just beyond the frontier, offering credit tailored to regions' industries. Infrastructure investments followed: roads, ports, storage facilities, built to serve trade that technically lay outside their domain. Without deploying a single soldier, they extended influence deeper into contested land. The buildup intensified when severe harvest failure struck the frontier. Relief funds arrived, but not from the official capital. They came from foreign institutions already embedded in the local economy. Aid was distributed in stable currency, tied to future trade agreements. Grateful communities accepted help without considering the long-term cost. Survival mattered more than sovereignty. Courts faced an impossible dilemma. Disputes increasingly involved contracts denominated in foreign money, governed by external legal standards. Ruling against them risked economic paralysis. Ruling in favor quietly acknowledged another authority's reach. Judges chose pragmatism, case by case, decision by decision, eroding borders with every ruling. What looked like accommodation was actually surrender by attrition. The territory had not been invaded, it had been absorbed, and the final recognition of that truth was still to come. The moment of reckoning arrived when officials attempted to formalize what had already happened in practice. A census of revenues revealed the truth no decree could disguise. More than half of all economic activity in the frontier region now settled in foreign currency. Local banks held reserves abroad. Wages were calculated using external exchange rates. Even municipal budgets relied on loans issued beyond the border. The territory remained politically claimed, but financially lost. The conflict sharpened when the central authority announced a monetary reset. New notes were issued. Old debts were redenominated. Citizens were ordered to convert holdings back into the national currency at a fixed rate. On paper, it was decisive. In reality, it was catastrophic. Conversion lines stretched through towns as people rushed to protect savings before value evaporated. Black markets surged overnight. The gap between official policy and lived reality became impossible to ignore. Border communities resisted not with violence, but with withdrawal. Businesses closed rather than comply. Farmers withheld produce. Guilds suspended operations. Their message was silent but unmistakable. Economic life could not be forced back into a system it had already outgrown. Authority without trust was meaningless. Neighboring powers seized the moment. They offered legal recognition for existing contracts, protection for assets held in their currency, and access to broader markets in exchange for formal alignment. The proposal was framed as cooperation, but everyone understood its meaning: accept their system or face isolation. The buildup reached its peak when a coalition of frontier municipalities petitioned for administrative autonomy under cross-border economic agreements. They did not speak of secession. They spoke of necessity. Food, wages, credit, and survival all flowed in one direction now. Political borders, they argued, must reflect economic reality. The central authority denounced the petition as betrayal. But condemnation could not reverse gravity. The Treasury could no longer fund services in a region that no longer paid into it. Soldiers could enforce borders, but not prosperity. Courts could issue rulings, but not confidence. And so, quietly, reluctantly, the decision was made, not with treaties signed in marble halls, but with administrative memos and revised tax maps. Jurisdictions shifted, customs posts moved, laws were harmonized to match the currency already in use. The border followed the money, not because anyone wanted it to, but because nothing else could hold it in place. The climax was not a moment of collapse, but of recognition. Power had moved without conquest. Territory had changed hands without war. The map had been redrawn by accounting entries, not armies. And Europe learned a lesson it would repeat many times afterward. When money chooses where to live, borders eventually follow. The adjustment settled slowly, like dust after a distant collapse. Life in the newly aligned region continued with fewer disruptions than anyone had expected. Trade stabilized. Credit flowed again. Courts enforced contracts without contradiction. For residents, the borders movement felt less like loss and more like relief. Daily life mattered more than flags once the uncertainty lifted. The climax, however, unfolded far from the frontier. In the capital, officials stared at revised maps with a mixture of disbelief and shame. The territory had not been conquered, yet it was gone. There had been no uprising to suppress, no army to defeat. Authority had simply dissolved where it could no longer pay for loyalty. The realization cut deeper than defeat in war. The resolution forced a reckoning across Europe. Governments began tracking not only borders and populations, but capital flows and currency adoption. Financial institutions were treated as strategic assets. Monetary policy became inseparable from national security. States learned that sovereignty was no longer defined solely by land and force, but by trust in money and the systems that sustained it. In the frontier region, the story became a quiet warning pass between generations. They remember how change arrived, not with violence, but with invoices, loans, and wages. They understood that power does not always announce itself. Sometimes it simply offers better terms. What this episode revealed was unsettling and enduring. Borders are not fixed by history alone. They are maintained by systems that make life function. When those systems fail, people follow what works. And today, as currencies move faster than ever, The lesson echoes with renewed urgency. So what do you think? Are we repeating the same mistake again? When